Most readers of financial information want to determine the performance of a company so that they can make a good decision on whether to do business or invest in them. Remember, we talked earlier in that a lot of times we want to be able to take a company's financial information and compare it to other companies or the industry average. Because of the various sizes of companies, taking a look at companies just by dollars doesn't always make sense. So we therefore, when we evaluate profitability, we take a look at ratios. One of the first ratios we look at is the gross profit ratio. The gross profit ratio tells us the percentage of profit we're making on every sale. So if we're taking sales minus cost of goods sold, giving us gross profit, we can use the sale as the denominator and the gross profit as the numerator of the fraction to determine a percentage. So we could look at a situation like this. The gross profit rate is the gross profit divided by net sales. Now this would give you a fraction multiplied times 100 to give you your percentage. Now the good part of this is that this then gives you an idea of how well the company is doing in making a profit on the sale of inventory. In this example here, REI, a sporting goods store, in 2010 has a gross profit rate of 43.9%. In other words, for every $1 of sale, they're making a profit of 43.9 cents. Now, this percentage is less than 2009, but not significantly so. Compared to its competitors, Dick's Sporting Goods of 29.7% or the industry average of 34%, we could feel pretty comfortable that REI does a very good job in its sales because of the profit it makes. The profit margin ratio measures the percentage of each dollar of sales as a result of net income. Now, the profit margin ratio is different than the gross profit ratio. The gross profit ratio was gross profit compared to net sales. The profit margin ratio is at the very bottom, net income compared to net sales. So here, as we look at REI again, where we take net income divided by net sales, notice here our profit margin ratio of 1.8% in 2010 and 2% in 2009 is lower than Dick's Sporting Goods and the industry average. Knowing that the gross profit ratio was higher for REI than the comparison companies, what could you figure REI when it comes to the profit margin ratio, which is lower? Would that tell you that the operating expenses are higher for REI than Dick's Sporting Goods and the industry average? Something to think about as we compare the ratios. We mentioned before how important cash is to a company. The quality of earnings ratio compares the cash that's being generated by operating activities to net income. So as we look at this as cash being generated, if we substantially increase the amount of cash to the net income being recognized, we would have a greater than 1 result in this ratio. If it's less than 1, it basically means that we're not generating as much cash as the income that we're recognizing. So once again, we're trying to show you here how important it is to take a look at ratios as we're analyzing financial information in any company.